has made a very 20th century move. Solve 21st century problem. How do you keep rewarding shareholders in an energy transition but is still fundamentally an oil and gas company? On Monday, Shell said that it has agreed to buy ARC Resources, Canadian energy producer, in a deal worth more than $16 billion. The acquisition will boost Shell's production by roughly 370,000 barrels equivalent of oil a day, and, in Shell's word, add an asset that can support its portfolio for decades. Shell is telling its investors to expect double-digit returns on the deal and higher free cash flow per share starting in 2027. Thank you for listening to Business Insights Daily. I'm your host, Srikank. When a major oil company buys more oil in a warming world, as you listen, in the back of your mind, what does it mean when a company that talks about net zero and renewables spends about $16 billion to lock in more fossil fuel output for decades? Let's start what's actually happening. Shell is acquiring ARC Resources in a transaction valued north of $16 billion. ARC is a major Canadian producer with a portfolio focused on natural gas and liquids rich plays, particularly in Western Canada. Both per Shell headline numbers are about 370,000 barrels of oil equivalent per day added to its production profile, a resource base that can support out long into the future and expected double-digit returns on the capital side. Promise that the free flow of cash per share, essentially when the cash available to reward shareholders, will increase starting in 2027. In other words, this is not a small tuck-in. The bet adding substantial, relatively low cost North American resource can improve Shell's earning power and cash generation in the back half of this decade and beyond. Is this a bridge to the future or a bet on the past? Which leads to our second question of the day. Is Shell framing this as a way to fund its transition, or is it in practice a reaffirmation that oil and gas will stay at the center of its business for much longer than any climate scenarios can assume? So why ARC, and more importantly, why now? There are a few strategic reasons it makes this deal make sense from Shell's perspective. Number one, scale and quality of resources. ARC holds significant positions in profit connected plays, especially in gas-rich and liquid-rich fields, feed both domestic demand and export markets. For a super major like Shell, adding that contiguous, high-quality asset can simplify operations and reduce costs over time. Number two, North American exposure. Canada offers a stable rule of law, established infrastructure, and proximity to the US, key market for gas, LNG, and refined products. In a world where some regions are political riskier, doubling down on North America could feel like a safer long term. Number three, gas and transition narratives. Companies like Shell increasingly present natural gas as a transition fuel, cleaner than coal, flexible, and critical for balancing renewables. ARC's heavy gas push portfolio fits the story. It's a fossil, but can be framed as part of the lower carbon mix compared with alternates. Number four, timing and valuations. After years of underinvestment and volatile prices, many producers focus on returning cash to shareholders rather than just excessive growth. A large strategic buyer can sometimes pick up assets on terms that are attractive in a long year price scenario. What this means financially for Shell. From a financial standpoint, Shell is pitching this deal as a fancy way of saying it will make each share more valuable over time. Key elements of that pitch are those double digit returns. Shell anticipates that the cash generated by ARC's assets after operating costs and necessary reinvestment will exceed the cost of its capital by a solid margin. That's what the double-digit return suggests. Free flow cash per share uplift in 2027. Once integration costs are absorbed and any near-term capex is spent, Shell expects ARC's contribution to increase amount of cash available per share for dividends, buybacks, and additional investments. Number three, portfolio balancing. Adding low-cost barrels and gas molecules can help smooth earnings in a volatile price environment. If the asset performs well, they can act as a cash engine to support both shareholder returns and whatever low-carbon investments Shell chooses to make. For investors who prioritize yield and capital decline, it's an appealing story. More cash, not just more volume. Can you finance a transition, this thing you're trying to transition away from? Which brings us to the third question. The plan is to use profitable fossil assets, fund cleaner energy. How long could that balancing act be held? At the same time, things such as investments in renewable biofuels, hydrogen, and EV charging, Shell has pledged towards these, while at the same time it has walked back some of its aggressive targets under pressure to keep returns high. The ARC acquisition highlights attention. On one side, Shell can argue that natural gas, especially if used to displace coal or paired with carbon capture, part of a pragmatic path to lower emissions. We can also say that strong cash flows from those assets are necessary to fund riskier, low return green investments. The other, expanding fossil fuels production for capacity for decades sends a signal that Shell expects and is planning for. Sustained demand for oil and gas well beyond what many 1.5 degree, 2 degrees Celsius climate pathways envision. For climate advocates and some investors, the question is whether deals like this lock in emissions and infrastructure will be hard to unwind later, or whether they are. Shell might say king assets that will eventually taper into cleaner technologies at scale. What this means for the market and you. So, what does this actually mean outside Shell's shareholder base? For the energy market, consolidation among producers can mean fewer players with more pricing power, especially if they stay disciplined about not oversupplying the market. Access to Canadian gas and liquids can support long-term LNG contracts and petrochemical feedstock supply, influencing global pricing dynamics.